Okay, now the last time I got as far as here, I put 2,500 into the sales. Okay, so that made our equity go up. Sales is a mini equity account. Okay, to make a mini equity account go up, you credit. All right, so I put 2.5 there. And then there was a problem with the formulas, so I had to correct them, but that's okay, they're corrected now. So you can see that actually the blues are not balanced. The reason for that is because there's 2.5 of a difference. I just did single entry, and that's how you'll know you've just done single entry, because these won't actually, be equal. So where is this going? Well, this is going to, I'm going to call it debtors, okay? Old word, but I've got the new words in the T account if you look over to the left. So 2.5 debtors, okay? Now, then we've got to make our assets go up. Now, I said up here and I showed it up here that debtors go up, okay? Now, if you sold them cash, your cash would have gone up, all right? But in business, there will be a lot of credit sales. So credit sales, when you make them, they are recorded and they are regarded as an asset because these people will eventually pay us. Well, most of them will, but they should do. And when they do, they convert into cash. Okay. But I often call debtors one step before cash. Debtors, sales ledger control account, or receivables one step before cash because, they are going to become cash. Therefore, they are regarded as an asset. So over here, we've got debtors. Okay. And I'm going to make the debtors go up. Now, debtors are an asset. So just to quickly revise, debtors are an asset. Asset, that's an asset. Okay. How do we make an asset go up? Debit or credit? Well, if you look at it, debit it. Okay. Debit it makes it go up. So here we have the T account. This is the debit side of the T account. This is the credit side of the T account. Which side do we put it in? Well, we put it in the debit side. Like that. Now, if we look at the blues, you should see that the blues are balanced. Okay. So that's what keeps our balance sheet balanced. And at the moment, it's a balance sheet that we're dealing with. Okay. Where did that come from? That came from the sales. Okay. Like that. Now, next thing is, so that's right, we sold that. Oh yeah, so basically there's other names for debtors, receivables or sales ledger control account. I like the word receivables actually because it gives a good idea of what these are. These are receivable to us. We are going to receive this money from these people, therefore they are receivables. Sales ledger control account, it's okay, they use that as well. All right. Now, but of course, all this credit, it's all fine. It all needs to be recorded. But at the end of it all needs to be either paid off or collected in. Okay. So the day of reckoning comes where you have to actually pay it off or where you have to collect it in. Okay. Now, so then it says here, fully paid off. This is number 8 over to the right here. Fully paid off people we owe money to. And I've conveniently called them creditors, payables, and you can't see it there, but basically it's purchase ledger control account. But you can see it here actually, purchase ledger control account. Okay, now, so again, I think when we look at the assets for this, it's reasonably easy to sort of understand. If you pay somebody off, what's going to happen to your assets, particularly what's going to happen to your cash? Okay, well, it's going to go down. Okay, so I'll just change this a little bit. Okay, so your bank is going to go down. Now, this is probably going to come up in little tiny. Oh no. So your bank is going to go down. So you'd put that there. And actually, okay, I'll say paid off the people we owe money to. And how much do we owe? Well, we owe £1,000. Okay, so you can tell how much you owe in the liabilities. Okay, so it's very important to be keeping an eye on that. It's, of course, great to be keeping an eye on your assets, but it's also very important to know how much money we owe to people. So there's £1,000 there that we owe people. So we want to pay them off. So what's going to happen is our bank is going to go down. And then we're going to clear our liabilities. Okay. And that makes our liabilities go down. Okay, now I have done that a little bit outside the formulas there. Okay, but when I do it in the T accounts, then the formulas will kick in. Okay, so bank needs to go down. So there, bank is an asset. Bank is an asset be as an asset. Okay, how do we make an asset go down? Debit or credit? Well, credit. Okay, so we go over here and we put 1,000. Okay, so you can see straight away that the blues have gone down. All right, now where is that going to? That's going to, and I'm just going to put CRS. Creditors. Okay, now, so then we need to make this go down. How do we make creditors go down? So how do we make creditors go down? Well, look at liabilities. Creditors are a liability. So creditors are a liability, and credit makes liabilities go up, debit makes liabilities go down. So to make creditors, there's debit, there's credit, that's the debit side, that's the credit side. So to make creditors go down, you debit them. Say that comes from the bank. Okay, blues should now be balanced. They are. Okay, so that's it. Double entry has been completed for number 8. And then number 9, last one, we fully collected the money from the people that owed us. And it's a little bit out of screen there, but that's debtors, receivables, or sales ledger control account. Well, in fact, over here, you can see it, debtors, receivables, sales ledger control account. Now, when this happens, what in fact happens is your debtors go down. Okay, so your debtors or your sales ledger control or your receivables go down, and your bank, I'm going to kind of cheat a bit and put that there, so your bank goes up. Okay, so your bank goes up. Now, so therefore, how do we do that? Well, if we look at debit and credit terms, there's an asset, the debtors go down, so therefore we will credit the debtors and we will debit the bank. Okay, so we want these people to pay us off, so what we'll do is we'll go here, okay, and so which side is, this is debit, this is credit, the debtors are going down, so we go over here, 2.5 like that. Where is that going to? It's going to go to the bank. Okay, and then now we can see that that is not balanced. But then we do this over here, debtors, okay, and they go up 2.5. And that's it. Our blues are balanced. Okay, and that's it. Now, that will happen a lot. Okay, that's a transaction you need to be well able to do. In other words, to be able to make a sale and create debtors, and then when the debtors pay us off, decrease the debtors and increase the bank. So we're just tracking everything that happens. Now, as you can see as well, everything is balanced. Okay, and we have used T accounts there, and that's it. That's really how you do double entry bookkeeping. Okay, now there's a few other bits and pieces I need to do as well. I need to tidy it up. We're going to have to balance these accounts. I'm going to have to explain one or two little things. But if you were doing purely balance sheet accounting, that's what it is. That's basically balance sheet accounting. And I hope that I've shown you how the T accounts are related to the 3 master accounts. And I hope as well that I've shown you that each account, although there could be millions of accounts, each one has to be one of these. They're like a mini master account. Okay, so I put them conveniently underneath, so that, you can definitely see where they're coming from. All these equity are coming from here, liabilities coming from here, A coming from here. When people do this on a piece of rough paper, they put T accounts all over the place. That can be a bit confusing, but so long as you know, and so long as you're able to identify which master account each little T account is, then you'll still be okay. Okay, now also, of course, some people will say, well, hang on, where's the P&L? Yeah, I'm going to get to that. Okay, but I'm starting first with the simplest stuff. Okay, so you could do a style of accounting here, and I'm calling this balance sheet accounting. Okay, it's okay, but it gets expanded because it has certain limitations. Okay. But anyway, if you get that much, very good. Okay. Thank you.